Contrary to what many people think, home prices could drop as mortgage rates come down. People like Dave Ramsey and Barbara Corcoran have been creating a lot of FOMO in the housing market, saying the prices will skyrocket from already inflated prices when the mortgage rates come down because of a lot of pent-up buyer demand. At first it sounds like a logical statement, but it's a gross oversimplification, and it might also show their lack of understanding of how mortgage rates work in conjunction to the Federal Reserve's expected rate cuts. I believe that by the time mortgage rates hit 5% or below in the US, it won't be any time in 2024. And when it does happen, things will actually look a lot more different from today. In today's video, I'm going to talk about what that might look like and why that could mean further decline in home prices. Before we go any further, if you can hit that like button below and subscribe, it will help me out tremendously to produce more content. Housing market is currently extremely unaffordable. Home prices shot up over 33% and in some areas over 70% since the pandemic started, while inflation-adjusted real income has been going down. A lot of this was from investor speculation in many markets. To make things even worse, mortgage rates shot up from 3% to over 8% as of 2023, making home purchases out of reach for most Americans. US housing affordability is at record low. So the question is, if the mortgage rates go back down to say 5% or below, what will happen to home prices? Most people in the real estate industry will tell you that home prices will skyrocket from where it is because of the pent-up buyer demand. They'll tell you now is the best time to buy before home prices go even higher. Let me show you a clip of Barbara Corcoran about what she thinks about the home prices when rates go down.
Do you feel houses will be more affordable in the future? It seems hard to find a house anymore that is going for the price it is worth.
House prices are not going to come down. I believe that when the real estate interest rates come down, when the mortgage rates come down, all hell's going to, ooh, you're not supposed to say that.
It's morning television, not you're on Shark Tank.
Every buyer on the sideline is going to jump into the market as long as the interest rates come down to 5 or 4%, and houses are going to go up in price all over again. I wouldn't be surprised if they go up by as much as 10 or 15% when that happens.
Oh, wow.
Most people might think what she's saying makes perfect sense, and realtors across the country are using that logic to persuade home buyers to jump into the market. But I'm gonna have to disagree with this. Her statement assumes number one, the state of the US economy will stay constant when the mortgage rates drop, say, below 5%. And number two, the supply and demand dynamic stays unchanged. Also, I believe 5% mortgage is long ways ahead. Mortgage rates don't just drop over 200 basis points overnight. So it's important to realize that if the 5% does happen, it will be years later if we don't have a recession. The longer we stay at higher rates, higher the recession probability gets. So why 5%? According to this study by John Burns Research and Consulting, 5% mortgage rate is the magic number to entice sellers to finally move out of their current home locked under a low mortgage rate, whether it's for getting a bigger house or downsizing. Homeowners typically spend average 5 years in their first home, so by the time 5% happens, the pent-up demand for home sellers will be sky high. They probably can't wait to get out of their 2-bedroom, 1-bath house with 2 children and a dog. And of course, every home seller creates a buyer demand to buy something else. But it may not be such a simple case when that finally happens. Mortgage rates can drop to 5% or below in 2 ways. Number one, through a recession, and it will happen sooner with the recession. And number two, soft landing in the US economy with no recession, in which case it will take many more years. Either way, that kind of drop in mortgage rates takes many years, even if the Federal Reserve cuts the interest rate to 0% today. And the truth is, a lot can happen during those years. I'm going to talk about what's going to happen to home prices in either case in a little bit. But first, it's important to learn how mortgage rates work and its relationship with the federal funds rate. Most people think when the Federal Reserve lowers the interest rate, aka Fed funds rate, the mortgage rate will also come down. While there is a correlation, these two are not directly proportionate because mortgage rates are set by the longer-term 10-year Treasury yields, which the Fed cannot control. Look at this chart showing the historic Fed funds rate with a 30-year mortgage rate. When the Fed funds rate comes down, it takes a long, slow grind down for mortgage rates. Look at the period from 2009 to 2015 when the Fed funds rate stayed at 0. Mortgage rates still hovered around 4% or higher during that time. And mortgage rates are usually much higher than the 10-year Treasury yields because of the mortgage spread. That spread between the Treasury yields and the MBS rates can be affected by a number of market risk factors, including the economy, inflation, and general investors' appetite for mortgage-backed security. If banks and financial institutions think buying MBS is risky or there's a better return out there somewhere, it will make mortgage rates that much higher. Currently, the spread is really high due to the uncertainty in our economy. Last time we saw a spread like this was in 2008. So let's get back to the home price discussion. Let's first assume a scenario of soft landing of the economy with no recession to see when mortgage rates might come down to 5% and what happens to home prices by then. First of all, we're not going to get 5% mortgage rates anytime soon. Based on the latest Federal Reserve dot plot from the Summary of Economic Projections in December 2023, without a disruptive event like a recession, the longer run neutral rate of the Fed funds rate of 2.5 does not happen until 2027. Even at 2.5% Fed funds rate, I doubt that mortgage rates will be that low. It could still be at around 6% looking at this chart once again. So if 5% mortgage rate still happens without a recession, it could be around 2027 or later. So what about the home prices then? The higher mortgage rates for longer means homes will continue to be extremely unaffordable. Unless the income rises significantly, not many will be able to afford a home. And I know that the median income will not go up by 50%, so without a recession, it will be the same story as today. Transactions and supply will stay low, but also the demand will stay low due to unaffordability. People who have to sell will still sell from death and divorce, and cash buyers will eventually run out without much investor demand. So overall, I think home prices will stay flat or go down slowly about 5 to 10% until that 5% mortgage happens due to low inventories. After we reach that 5%, we may experience a supply glut. In the next 3 years, there will be a lot of new construction homes that will take advantage of the low inventory situation and entice home buyers with rates buy downs and price cuts. It's already happening. 3 years is a long time, and this could have absorbed a lot of the new buyer demand. And when the 5% mortgage rate finally comes, it will unlock a lot of the existing home inventories, and we may have a situation where old houses have to compete against the lower comps of new construction homes. Also, home builders have a lot more room to negotiate home prices, evidenced by what's already been happening. They're lowering prices, especially with lower lumber prices as their costs go down. As a home buyer, I wouldn't buy an outdated, uninspiring old house for $30,000 more than a brand new house with everything that is modern. Overall, still, even after the 5% mortgage rate, I just don't think we'll see home prices increase. If anything, it will stay flat until the income level catches up, which can take a long time. Even with 5% mortgage rates with current prices, homes are still extremely unaffordable with the median household income in the US being so low. So I'm not sure how much more demand there will be at the time from new home buyers. And of course, all this is assuming there will be no recession and unemployment rate stays low. And there's a significant chance that the US economy falls into a recession in the next 12 months. Rates stay higher for longer, chances for a recession go up even higher. I talked about the recession probabilities in my previous video, but let's say there's a hard landing in the US and global economy, and the unemployment rate soars above 10%. As a response, the Federal Reserve cuts the Fed funds rate to 0. This one's not hard to guess. I think when this happens, the housing market corrects 15 to 20% rather quickly. First, this will dramatically reduce the buyer demand. No one wants to buy a house when they're not feeling very secure about their job. There will be lots of layoffs, and it will also create a lot of forced sellers. A lot of new homeowners that bought a home after the pandemic have been barely keeping it together with their income versus high mortgage payments. Any disruption with their job, such as a layoff, will cause them to give up their house. That will cause prices to drop, and this will be more of a sharper drop. I still don't think mortgage rates will drop below 4% this time, even with the recession, unless the Fed starts buying mortgage-backed securities again, which is highly unlikely. Overall, I think home prices will drop over time. Nothing too dramatic like it did in 2008, but with the current unaffordable prices and the likelihood of mortgage rates staying higher for much longer, coupled with recession probabilities, it's not going anywhere up from here. If anything, home prices will correct downward in the coming years. That's it. If you like this video, please hit that like button below and subscribe for more content.